So you are down about 100,000 because last time we spoke, I think you were on about 600,000. How do you feel about that, by the way?
I don't feel anything about it. In fact, I feel excited because I want to buy more. Price does not equal value, which is why when prices come down or when they go up, we're not getting emotional.
Do you believe youth beats age and experience?
My answer is it depends on the objective. So youth, building knowledge without already having bad habits, age and experience, more emotional discipline from past mistakes. For me personally, I want to reach 10 million in my 20s.
Okay, so when you're 21 or when you're 29?
In my 20s, but I'm thinking 25.
What's a good belief to have then, do you think?
Long-term wealth creation is one. Another one is
I get messages all the time asking me how I went from 100,000 in bad debt to a $13 million portfolio. By watching this show every week, I will share exactly how I did it, how I achieved it, and the lessons that I've learned along the way. So do me a favor and please subscribe to our channel. It's simple, it's free, and it helps keep the show going for you. This is where you eat and we talk about changing the way that you think about money, with insights from successful investors, entrepreneurs, and everyday people taking control of their financial futures. So double check that you're subscribed, and thank you for being part of this journey. Welcome everybody to the Lunchtime Investor. Remember, this is the time when you eat and we do the talking. So enjoy. And we're going to be talking about what is the right age to start investing. And I can't think of anybody better than to have our 19-year-old incumbent trading superstar Taylor here. So welcome back, Taylor.
Marcus, thank you for having me.
All righty, I get a handshake as well. That is awesome. Thank you. And it's pretty awesome because, you know, we're going to be discussing, is there really a too early thing? I'm going to ask you now, do you think is there an age which is too early?
No, it's not too early.
What about too late?
No, there's no such thing as too early or too late.
Okay.
It's more so about empowering yourself. It's about empowering yourself, and it's you being clear with yourself. Okay, if I want to achieve wealth, cool. What strategy can I use? And no, another important thing is the mindset. You talk about the mindset, which is really important. And there isn't an age which is too late or too early to start investing.
But do you have that mindset? That's what we're going to be coming on to when you start too early, maybe. You know, do you have that mindset? So what's coming up is whether age or mindset matters more. For example, I get a feeling you're going to have some strong opinions on this. How much money you really need to begin, right? And the number one thing you need to start, no matter what your age is. Okay, so as a teenager, you're still a teenager.
Yes, I'm still a teenager.
You're still a teenager, right? And you are now at around 500,000, 500,000.
Yes.
So you're down. You are down at about 100,000 because last time we spoke, I think in between the last episode, I think you were on about 600,000. How do you feel about that, by the way?
I don't feel anything about it. In fact, I feel excited because I want to buy more. And I am buying more at these low prices. And I'm using the strategies to do that. Because I know I have that foundation, I have that mindset, which is that we want to be getting in as the prices come down. And it's recognizing that price does not equal value. Price does not equal value, which is why when prices come down or when they go up, we're not getting emotional. And we're using their strategies no matter if the market goes up or if the market goes down.
I like it. So as a teenager, you now have only 500,000 now. Do you believe youth beats age and experience?
My answer is it depends on the objective. So if you look at these two things, youth and age and experience, let's talk about them. So youth, that is building knowledge without already having bad habits and more time to compound wealth. That's a good thing. Age and experience, so that is more emotional discipline from past mistakes, being more patient and not being drawn towards get-rich-quick schemes. So both of these things are good, actually. I don't believe that they're competing with each other. However, if you're young, then you do have more time and you can use that time more effectively, especially when you're young. And that can help towards if you want to build wealth and starting young.
Yeah, that's true. So because of compounding, I mean, the earlier the better. And even if, you know, like me, I started doing it for my children when they were just 3 months old, because that's a bit young. When you say too young, I think that's probably a bit young. Like, yeah. I don't know. So I did, but to teach them, but to start doing it for them. Absolutely, start doing it. Do it with a junior ISA if you're in the UK. Junior ISA. You can do a self-invested personal pension at the age of 3 months. You know, and I think that our Matt.
Yeah.
You know, he wanted to beat that. So he started at 1 month with his child, which is absolutely fantastic.
This is amazing.
Yeah. So you've got a bit of, build knowledge without really having bad habits. That is so true. And also the mindset, because a lot of people that start, what do you think if they've read about it or they have an uncle and it didn't work well, etc., and then they go in maybe thinking that they can't do it, but younger people maybe don't have those limiting beliefs, right?
Yeah, they don't have those limiting beliefs. And it's also about the environment. You need a positive environment. I remember you mentioned that Napoleon Hill, who interviewed many successful investors and entrepreneurs in his lifetime, he gave two main takeaways. One of them was to have a purpose, and the second one was the environment, who you surround yourself with. That's very important. So you need to have a great environment. And what you can do if you're someone who's young, you can really immerse yourself with all these positive and productive tools. For example, books like The Wealth Workout or Think and Grow Rich by Napoleon Hill or Secrets of the Millionaire Mind by T. Harv Eker. Now, this is really going to help develop the mindset, and that's really important.
No, I agree. But when you're very young, can you choose your environment? Like I can choose my environment. Can you really choose your environment when you're, let's say, I don't know, 12, 13, 14, 15?
You don't have too much influence on your environment.
Yeah, that's the challenge, isn't it? But your environment doesn't have to be people. It could be books.
Yes, it could be books.
It could be online courses. That could be your environment as well, right?
Yeah. It's not actually limited to a specific place, but it's also a mental environment. So what can you listen to? Audio books or these books here.
Yeah, audiobooks, that's true. I mean, I think a lot of people, when they're driving, they listen probably to the radio. I'm not quite sure. I used to watch Leading Britain's Conversation, LBC, because it's really like grown-up stuff. But the thing is, it's all negative. It's always about war and this politician did this. And it's just like, man, I got to stop listening to this rubbish.
Yeah, it's quite a low vibrational frequency.
Absolutely.
Yeah.
I love it. Okay, so no matter what your age, I guess, getting started is the most important part.
It is.
Okay, so here's an example why, and I think it's Steve Bartlett who's going to talk about this. So I'm going to play this in 3, 2, 1, and
someone who has never invested before.
Yeah.
Which would probably be the majority of the audience. How do we simplify even further?
Set it and forget it. Keep putting this little money away on the side. It's going to compound. At 18, if you put away $5,000, if you got a 10% return on that money,
Every year.
let's say, every 7 years, it would double. 50 years is 7 doubles. Fast forward to when you're 68, 50 years later, you're going to have 100 times what you started with. So the 5,000 at 18 is going to be 500,000. Okay? At 19, if you put money away, that's another 500,000. 20, you might have 10,000 you can put in. So you can start seeing that over a lifetime, you're going to be having too much money.
having too much money. What do you think of that last statement? I know he was kind of joking, but what do you think of that last statement?
I think it's interesting. And what I do like about what he says is he has a long-term wealth approach. And that is with setting it and forgetting it for investing. And that's a good approach because you're not being emotional with your money and you don't need it in a short term. And that building wealth with investing is a long-term approach. However, what he said with 10% a year, I don't think that's enough, factoring in inflation, first of all, and second of all, the compounding growth of the money supply. I think that 10% a year is not going to be enough to build long-term wealth because inflation is keeping on rising. It's keeping on creeping up.
So you mean that the 500,000 won't actually be worth 500,000 in buying terms because everything's more expensive?
Yes, in buying terms. It will mean the same as 500,000 at that time, at that current time, after all that time. However, it won't have the same purchasing power. Yeah,
it won't have the same purchasing power. So 500,000. He says, yeah, it's too much money, but actually it's not enough money, you're saying. No. So you disagree with him. There's a couple of things. I like what he's trying to say, but I don't agree with the set and forget either. I just don't agree with that. I think, and that's why you only make 10% by setting and forgetting. Even though people here probably listening to this and watching this think 10% is really good, it's actually not, like for the reasons that you said. And also, let's not forget that's an average, right? So sometimes it's more, sometimes it's going to be less. That's an average. I think he really simplified it, but I think that's good to get people started. I think that's really good. Yeah, set and forget is probably not the right thing to do. Yeah. And imagine if you added some money to it even more every time it fell. So in the years that it actually fell, instead of setting and forgetting,
then you get to buy more as it comes down.
then
and then you
then
make
you're going to
more.
make even more, right? With more
Exactly.
money. Then
Exactly.
it might be closer to $1 million, which probably would be closer to 500,000 in buying power.
Yeah.
So look, investing young is good because you've got time on your side. Compounding. I think people hear about compounding, but they don't really understand it, right? And they don't really do it. I mean, who really does compounding?
Not many people.
No,
No. Certainly wealth-oriented people.
absolutely. And how would you describe compounding or compound growth?
So compound growth is when something grows at an increased rate every year. And what happens is it's consistent growth. So for example, if you're investing 3%, and you're making 3% per year, then the next year you're not just making 3%, but you're making 3% on the amount that's grown.
On a
Does that
larger
make sense?
number.
Yes.
Because you haven't spent that money, right?
No.
Mo-
You've
most people,
reinvested.
you reinvest it. I think most people want to make money for one reason and
To
one
spend
reason,
it.
to spend it
Yeah.
as soon as possible.
Yeah.
And if you could just delay that gratification, it's not very sexy,
No.
delaying gratification.
No.
So why do you like it so much then?
The rewards. You have to look at the long-term picture. Long-term.
What is your long-term picture then? You're on 500,000. What's your
It's-
long-term picture?
Well, for me personally, I want to reach 10 million in my 20s.
Okay.
But otherwise, I'm just thinking about the long term. I'm
Mhm.
just thinking about the long term. I'm not thinking about short term. And this is why what you talk about is correct also. And it's to have these different buckets, these income buckets, so that when money comes in from your income, you know where you're going to spend this money. And you're not going to spend all of it, but you're going to allocate it. You're going to allocate some towards your savings, some towards your investments, some towards your operations, which you have to spend on, so your necessities. And you need to know where your money is going rather than just sending all that money out.
So do you use the management? So we
Absolutely.
call them the pots, but do you use it?
Absolutely.
Oh, that's awesome.
Yeah.
Okay. Do you have like a give one as well, or not yet?
What does that mean?
Ah, that's a no then. Oh well, giving, charity, and stuff like that.
Oh, charity.
Do you do that yet?
Not yet, no.
Okay. And do you have a fun one?
This is interesting.
I think you're a saver.
I'm an investor. I don't like to save. I like to invest my money.
Mm.
I don't have a fun one too much. However, it's something that I'm going to continue as I continue to reinvest and make profits.
Okay, this is really interesting. Okay, because that's one thing that, and we learned it from the great T. Harv Eker, and he basically said, if you do not have that pot of fun, it's 10% normally, right? If you don't, which it sounds like you don't, and I have a problem doing it, and put a little bit more in the financial freedom, but I'm getting there, is because if you don't nurture your inner child to have fun, then when the big stuff comes along, it'll actually sabotage you. Because it says, you didn't look after me, now I'm going to trip you up.
Sabotage.
Yeah, so yes, because you didn't look after it, right? So for example, you're about to meet a billionaire, and that's your big chance at 19, and something will happen, you'll take the wrong turning to be late or something, and the billionaire will go, I don't deal with people who are late. And that's your chance gone because you didn't nurture your inner child. What do you think about that? It's quite heavy.
I think you have the right idea, and you do have to spend some amount of money on fun. I absolutely
So
agree
say,
with that.
I have to.
I have to. You're right, yeah. I have to spend money on fun. And I agree with that. And however, I like to invest my money currently, but it is something that I'm going to do in the future.
And when will that be in the future?
Well, once I'm taking out profits for this bull run as it continues to go up.
Because you don't have any income.
Not too much, no.
Not too much, yeah. Oh, interesting. Okay, and when you're older, obviously you can start, because we're talking about age here, right? You might have, I don't know whether you have more wisdom, because you have all those limiting beliefs as well, which young people don't. You have less time for compounding. I'm getting the feeling that the earlier you start, the better. I think that's basically it.
Absolutely.
Make those mistakes a
You
lot.
have less expenses as well when you're younger.
That's
You have
very
less
true.
Expenses.
Yeah, that's very true. Do you not pay any rent to your parents?
Not yet.
Not yet.
No.
Oh, they might be they might be watching this. Hey, listen, we're going to cut that bit out, okay? So we're looking basically to double, with the strategies that we teach, to double your money every 2 years, and it just goes dong 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 like that if you're not spending it, that is. Yeah, so that's absolutely fantastic. So again, no matter your age, what's the most important thing?
Discipline.
Mm-hmm.
Discipline and being strict with yourself, because sometimes you do have to be strict with yourself. It's easy to get emotional. For example, with spending habits. Oh yeah, I want to buy these new clothes because they look good. And you get emotionally attached to something, be it the markets or something in real life. And you have to take a step back And particularly if you want to build wealth over the long term, you need to ask yourself critical questions. Is this the right thing? Is this going to get me to where I'm going to go?
But I think even more important than that, beforehand, you're saying discipline, absolutely. And you look and sound like a very disciplined person. Even in your eating habits, like when I reach for a cake, you say, I've got to go and do 100 press-ups. What is that about? We said it was cake, and now suddenly it's like when I look at a bit of chocolate, I have to do 100.
Yeah.
How did that morph into that?
It was cake, and then it turned to everything.
When you say it, I never agreed to that.
Yes, you did.
No, I didn't.
You agreed with cake. You agreed with
Cake,
cake. And then Dennis and I also talked about that it's everything to do with sugar.
But what has Dennis got to do with anything?
You don't remember? I remember the team's meeting with Dennis, yeah.
Okay, well, you made that decision without me. Anyway, I think getting started is the most important thing. Getting started, right? Make your mistakes and then learn to be disciplined, etc.
Absolutely.
But you got to get started. And Harv always said, it's not because people say, well, I don't have the money. Start with whatever you have. It's not the amount of money. It's the habit.
Yes.
The habit.
Consistent habit with massive, imperfect, consistent action. That's what it is.
I love that. That's the Wealth Creation Masterclass. Okay, let's have a look at this. I don't know whether we can show this. What is with these names? Every time it's like this is death positive 2. Already I'm thinking this guy's or person is weird. Okay, at what age a person should start investing? Okay. I used to beat myself up for not starting earlier, but now I'm in my 40s and started investing a few years ago. I'm glad I waited. This goes against everything we're saying, Taylor. This person's glad they waited. When I was younger, I didn't have, okay, they can't write either. I didn't have the something spent money as I got and lacked financial stability. I have no idea what that just means, but I fully believe I would have panicked and sold at the worst times, plus never been patient enough to wait for the big wins. How interesting. Now with more life experience and a better understanding of myself, there's something to be said about that actually, I'm far more consistent and realistic about long-term growth. See, that's the wisdom of doing a little bit older, right? I've made the decision to not get my 2 teenage kids involved in investing yet. What? Wow. Okay, as I feel like it would be a waste of their time until they're more mature with money. Am I making the right decision? What the rah, as my youngest would say. Whoa, go on. You go first because I'm going to scream.
So in here, I think there's a good idea and there's a bad idea. The good idea is that they want to make sure that their kids are mature. However, something that's not so good is that they think maturity is due to age and not due to wisdom and learning. And that's the main difference I see.
Wow, that is awesome. Yeah, because when are they going to, and what are they doing to help them mature? Because I think the fastest way is to start them. And by the way, they're not saying, I'm not going to teach them because they're not mature, so I am going to do it for them. They're just not doing it. I mean, they're just wasting valuable compounding time
opportunity.
Here.
Right, especially with inflation.
Hugely. And the other thing as well is, a couple of things. One, they could start a junior ISA, start putting money away for them, even if they're not growing it. And the second thing is education. It's like they're missing out on education. So, okay, when they're mature, then they're going to start learning, and then they're going to start doing it. Wow.
You have to have vehicles to grow your wealth.
Absolutely. Death positive. It's a big from me on this one, I have to tell you. Anything else on that?
No, I think you're absolutely right.
The sooner the better. This is awful. This makes me feel really sad for the kids. And they're two teenage kids.
Well, if you go back, it sounds like they weren't following a strategy and that they were emotional, particularly when they were younger. Now, if you do learn to follow a strategy, I think that could be a lot better.
Of course, absolutely. If you have a strategy, then you don't need as much maturity. You just say, just follow the strategy, Right, let's have a look. Delaying investing means, we've said this 10 million times. It delays taking advantage of compound growth, which again, I'm not sure people I remember Rob Aldous, right? He made 1.1 million on one account profit, and he had another one for his kids where he put 75,000, and he turned that into 375,000, and he did that in 3 years, which is fantastic, especially with the value cost averaging strategy, which is pretty good, right? For value cost averaging strategy. And I think I can't remember what I was going to say, but it was he said, Marcus, I understood here what you said about compounding, but I only understood it here once I saw an extra 100,000 in my account. He just didn't understand where that came from. And that's by keep reinvesting.
And time will do it.
And time. Although he did it in 3 years, but imagine what he could do in another 3 years.
Exactly.
Right?
And that's going to compound as well.
Massively. So what do you think about teaching your kids? Do you have to wait till they're old enough to teach them? Can you start for them? What do you think about that?
Well, actually, you don't have to wait until they're old enough, because that's a subjective statement. What you can do is you can really nurture their environment. So you can, for example, when I was in the car, when my mom used to drive me to and from school, we used to listen to Secrets of the Millionaire Mind audiobook.
No way.
I used to listen to that. And that was really something that really helped my mindset as well.
So again, for those of you who don't know, Secrets of the Millionaire Mind, that's a book by the great T. Harv Eker. That is like one of my top 3 books in the world. Absolutely incredible, the way that rich people think. And he gives perspective as opposed to not wealthy people yet. Which I was fantastic. So that's interesting, because some people don't like reading books, but you are listening to it. That's a different modality. And some people, if you keep listening and keep listening, and you could probably repeat half of it.
Exactly. Your brain takes in more information the more modalities you use.
Interesting. Okay. Right. Amazing. Okay. So what about this? Let's go through this. So you've got typical strengths, common mistakes, and best strategies for young investors, middle-aged investors, and late starters. Okay, so if I started right now, I'd be a late starter. Right, let's have a go. Why don't you do the young investor, since that's you?
So typical strengths of a young investor is that they have time to compound wealth over 40 plus years. Some common mistakes they have are chasing hype and being impatient. And the best strategies overall are to get educated and focus on consistency with building habits. I think that's absolutely spot on.
That is
consistency and strategy.
So don't worry too much about making a lot of money when you're younger. Focus on building habits.
Yes.
Consistency.
Yes.
And then there was another word that you mentioned. Strategy. It was something about
imperfect, massive, imperfect, consistent action.
No, but actually, it's the opposite. I think that at the beginning, don't be all about a massive action, And I think that's what most people do, especially when they're young. They open up a spread betting account, they chuck $5,000 in, and they go, right, I'm gonna like this. And I would say, don't even worry about that. Just do some really simple strategies.
Of course.
Like the guest from Stephen Bartlett said, just do that when you're starting off, just to get into it a little bit. Don't try and double your money, next month. Middle-aged investor, typical strength, strong stability, income, and growing experience. The common mistakes are fear of taking risks. But then the older you get, of course, then you have a fear of probably, approaching your pension. So therefore you want to start doing something. But there's the middle-aged investor. And the best strategies are investing steadily and increase investments in line with career growth. So again, increasing investments, so you don't have to start off with large amounts of money when you're young.
No.
Because you've got that thing you talked about, which is
time. And time.
Return on investment plus time. And people don't want to talk about time, but it's the time that is so important. So the sooner you start, the better. And then the late starter, 55 plus, which would be me if I started now. Strong self-control and clear motivation. I think I just said that. Wow. Okay, retirement. And then feeling it's too late to start could be a common mistake, though, right? And then maybe they don't start.
Yeah.
I mean, we had in your seat here, we had Henry.
Yeah.
There you go. And can you remember when he started?
I think it was less than 5 years ago or a few years ago.
How old was he? Do you remember?
In his 70s, right?
And even though we did it, there was a question which said, yeah, but I'm 70. And he had just said, but I started in my 70s. People... they kind of hear what they want to hear. And we said, but we just said that you can start when you're 70s. And he turned 5,000 into 450,000. I think he's above that now. He's up to 500,000 within 4 years, which, is pretty good, I would say.
Incredible. Yeah.
Okay, I agree. Yeah. The best strategies for a late starter is invest more initially and watch it grow using the same low-risk strategies. You don't have to take on more risk.
No, and you don't have to take all this massive action, particularly if you're starting out.
Yeah.
But as you get more and more into it, that's when you need to start immersing yourself in that environment.
But the thing is, though, these guys, the late starters, they're probably like in a rush. So they're going to want to be, they're a little bit like young people who want to and make a lot of money quickly. The late starters might make that mistake as well because they think they don't have a lot of time. What do you think?
No, it's absolutely wrong. You'll never not have enough time. You will always have time. And if you find yourself not having time, you can always make time, because there's an idea that you'll never find time, but you can make time.
No, I mean, they don't have that long.
Yeah.
If somebody's in their 50s and they maybe have 30 years, as opposed to somebody who's a little bit younger might have 40, 50, 60, 70 years, of return on investment.
But if they're older, they can still start and they can still make a difference with the strategies that they're doing. It's not an excuse to get out of it. It's really to empower yourself and to help you build long-term wealth.
And also, what about not just thinking about yourself, thinking about your children and your grandchildren? So it'll be a great hobby for somebody to start. It's great for the brain as well, keeps you occupied. We had a 73-year-old actually from, I think she was from Sweden, bless her, and she did pass away, but she was with us for a few years, and her husband contacted us and thanked us because it said, it occupied her and it gave her a hobby, and she loved it. She really loved it, which is absolutely fantastic. So thinking about the next generation, getting something started and building something with them or for them, and and passing on that education, that knowledge.
Absolutely.
Yeah. Okay. So what about this? No matter your age, this is the number one thing you need to master to be a successful investor. So apart from getting started, what do you think that might be?
Discipline, consistency, strategy. Those are all some things that can be in there.
Okay. Let's see. Discipline.
Yeah.
Beats age every time.
I won't say it beats age, because you can be successful with investing if you start out young, as well as if you start out middle-aged or old. So it's not a competition, I think, but it works, proven for many different age demographics.
Let's talk about that. You say it's not a competition, but actually, you mean against somebody else? Is that what you mean? Not a competition against somebody who's younger or older?
I'm saying it's not a competition between age as to who's more successful. Is it someone who's made money when they're young, or is it who's made money when they're older? In my view, it actually doesn't matter. It's more about the internal beliefs and their internal state. Are they using discipline? Are they taking consistent action? That's what I think is more
What's
important.
a good belief to have then, do you think?
Long-term wealth creation is one.
Okay.
Another one is consistently showing up. Showing up is really important consistently, because you can be emotional sometimes, and even using the strategies, it's completely normal to feel emotional about being in the markets when they can go up and down, particularly for new investors or for young investors. However, if you spend time in the markets, then you'll realize that using a strategy, you'll be absolutely fine as long as you're using a proven strategy and you're not attached to the short-term outcome of what happens. You're more focused on the long term.
Yeah, and I think that people listening to this, they go, well, what strategy? There must be millions of strategies out there, and then they shut down and then give their money to somebody else that they've never met.
They don't want
a nice brochure or something like that.
Yeah.
Because it's not normal for somebody, is it, to manage their own money? We give it to a money manager or an IFA, an independent financial advisor. I mean, is that something you would ever do?
No, personally, no.
Why? Why not?
I would like to take on the responsibility, and there's no right or wrong in giving it to a financial advisor. However, if you take on responsibility, most people think, no, I don't want to do that because that means I have to learn, I have to work, I have to put in effort. However, it really empowers you because you are in control of your financial future, and you will be able to make the decisions if you take responsibility and learn and use the strategies.
I actually think that nobody cares as much about your money as you do.
Absolutely.
So I think you are the perfect person to learn. And when you make a mistake, people think that's a terrible thing, but actually then you know what not to do next time. But when it comes to money, I tell you, people just have, they go crazy. Even really rational people, when it comes to money, they go absolutely crazy. So discipline, consistency, treat investing like a routine, not a rush. Routine. Is this what you mean by what did you say? Turning up every day? Is that what you said?
Every day. Every day. And you can spend, you don't have to spend a lot amount of time each day. You can spend 20 minutes a day or even less. I spend less than 20 minutes a day looking at my investments, and I'm also doing research and other pieces of work. But overall, as an investor, you don't have to be attached to the short-term outcome, and you can really use this strategy to check in consistently.
Yeah, I don't think, this point that you made earlier was so great. The great Warren Buffett always says that price does not equal value. I think that should be branded on our forehead, because when something drops by 20%, it doesn't mean 20% less revenue, 20% less profits, 20% less employees, 20% less factories, 20%. It's just that, and this is, people want to know, but then why? Why is it going up? Well, why does it go up? That's just the market. People is supply and demand, but also based on big institutions with large money, maybe rotating out of something, not because it's unsexy, maybe because it's unsexy, but because there's something sexier over there. So they might be going into gold right now. So they're not going into, let's say, Amazon. Amazon falls. But as soon as it falls enough and this one goes up, guess what they do? They rotate out of that one and go into this one and drive the whole thing back up again. It's like, oh, really?
Yeah.
And in the meantime, everyone's sold. That's why we buy.
Exactly.
So, but you've got to learn this. You just need to learn it. And it's just, we want to put this into every single household. Simple, profitable trading and investing strategies into every household. By the way, what do you think of the word trading? Do you think a lot of people go, whoa, Wolf of Wall Street, or what's that other film with Gordon Gekko? I can't even remember.
I'm not sure.
Okay, this is a different thing. He had 19, he doesn't know. But you know the Wolf of Wall Street?
Yeah.
Oh, you know that one. Okay, well, there was one. Oh, I think it was called Wall Street. It was called Wall Street. Just Wall Street,
Okay.
I think. Somebody's going to correct me on this, but I think it was just called Wall Street.
What's your question?
So they think that it's like that trading and investing is for these very aggressive and, screwing people over, which quite frankly, both of those films
And
were.
it's very emotional, isn't it? It's very emotional, very panic driven, whether that can be panic buying or panic selling. And what you have to do is you have to zoom out in the long term, and you need to use a strategy to get in.
What do you mean by
and
zoom
get
out? What do you mean zoom out?
You have to have a long-term perspective if you're building wealth, particularly with investing. A long-term perspective, meaning that price does not equal value. If you see the fundamentals of a company are doing great, but the price of that company is going down, that is one disparity, and you can look at that as a potential opportunity if you've done the fundamental research and if that meets the strategy criteria. So that allows you to get into these opportunities. No matter if the price is down, you can still get into these opportunities.
In fact, that's probably the best time because it's at a discount. How you talk about fundamental analysis without going too deep into it, but I understand doing fundamental analysis on a company because it's a real, profit-making enterprise. How do you do that with cryptos?
You're right. It's the same thing. You do it based on the company's fundamentals. Now, actually, this is really interesting. There's 20 to 30 million cryptos in the world. How many crypto companies do you think make around $1 million in monthly revenue or more?
Ooh, okay. I'm going to guess here. 1, 2, 3, 4. I don't know. Maybe 5 or 6. I don't know.
Well, there's around 50.
50.
So there's 20 to 30 million cryptos in the world,
Yeah.
but only about 50 crypto companies
Wow.
make $1 million a month in revenue or more. So that shows you that most cryptos are just hype and speculation, but there is a large amount of cryptos, be it 1%, for example, which is 200,000, for example. There is an amount of cryptos that you can look at the company's revenues, for example, you can look at their use case. That's what I like to do. I like to look at their, for example, monthly active users or their revenue or utility stats to show, is this crypto company valuable? That's what I like to do.
Yeah. And that was revenue. That wasn't profit. So you don't even know whether they have costs that outweigh that revenue as well. What about this? Focus on process over progress. What does that mean? Focus on process over... Oh, is that following a plan?
It's following a strategy and being consistent. That's what a process is. Are you showing up? Cool. Show up the next day. Show up the next day. Do this, do this. Now, some people think, no, I don't want to do that. That's too much responsibility. But would you rather a financial advisor control your money?
But actually, the way you describe it, right? If you just do this and do that and don't worry about the outcome, because that will come, you just follow this. Why is there then an emotion? I used to, when I was doing trading as opposed to investing, like intraday trading, I used to put, on my spread betting account, I used to put the actual monetary value off the screen so that I wouldn't become emotional. So I was just following the strategy.
And often, following this strategy is very easy for those who are getting started with demo accounts, for example, because you're not trading with your own money, and you can start with demo accounts, and they can be very valuable, and they can actually teach you to not get emotional with your money. So that's really important.
Amazing. Okay. Listen to this guy, 500,000 and climbing fast, I can tell you. Amazing. But just by following simple strategy, and you only take, you said, 20 minutes a day.
Less than 20 minutes.
Less than 20 minutes. Sometimes there's nothing to do, right?
No.
Because you invested. It's like,
Yeah.
what am I supposed to do now? Okay, if you want to get educated and build that discipline that we've been talking about, you can do so right here. How? By accessing 2 books for free, 2 separate books. The Lunchtime Trader, which is about stocks, and the Lunchtime Investor, which is about cryptos. You can grab them both below in the description. Okay, let's have some final thoughts here. So, the right age to start investing isn't a number?
No, it's about mindset.
Mm.
It's about, first of all, have a good environment and learn a simple, proven, successful strategy. That's what I think.
Yeah, absolutely. But when you go onto Google and you write, please can you give me a proven successful strategy, there are 6 million people trying to offer you their strategy. So, and there isn't more than, there isn't only one way. There are lots of ways of doing it, right?
Of course.
Yeah. What do you think of the components though? Because I think it's depending on how much time you have. There's no point teaching somebody intraday trading if they have a full-time job.
Yeah, you have different goals.
Yeah, and time, right? So also, what's your character? Are you the kind of person that follows rules, or are you not? You know, and risk tolerance. Some people just don't like risk at all.
Yeah. Yeah, you mentioned a point earlier that older people tend to be risk averse. However, that's potentially a negative because that may not allow you to achieve long-term wealth if you're not taking the necessary actions to build your wealth, for example, because the impact of inflation, that can be bad and that could hurt your progress towards affording a pension, for example.
Yeah. So 10 million you want to achieve, is that, so 10 million in your 20s, so when you're 21 or when you're 29? What?
In my 20s, but I'm thinking 25.
20, okay, so really in between your 20s. Okay, so when you're 25, 10 million, amazing. Well, hopefully we won't have to wait until then. Hopefully it's going to be a lot faster because of compounding. Could happen a lot faster. Okay, so listen, we always say, and I hope you enjoyed this episode of the Lunchtime Investor Show. We always say, if he can do it, you can do it too. You just need to learn how. So we'll see you next week on the show.